Sterling, good to see you in your house.
Thanks.
It's good to be here, and thanks for letting me be here. But we met a long time ago, and a lot has happened since then.
Yes.
It was way back, I reckon about 8 or 10 years ago,
Yes.
in the height of the global financial crisis when the world was in a different place.
Yes.
Do you remember that time?
Yes, we met at the US Consul General's residence in Zurich, and we're at a round table talking about how US politics was being influenced by what was still a growing Fox News network. And they had a US academic say that that Fox didn't have a massive influence on US politics. And I remember you and I met afterwards thinking that was not quite what was happening in America, and sadly we both turned out to be correct on that.
But having lived in America, it was pretty obvious to me that the world was changing
Yes.
very quickly, not just in media, but in the way that people were looking at the world, and influences around the world were changing too. And
Yes.
I think at that time, the global financial crisis really crystallised a whole lot of things, and events changed, and the American economy went into a whole different place, and
Yes.
then the global economy followed. So it was pretty obvious that there were going to be a whole new range of influences appearing. I don't think any of us predicted Donald Trump, but perhaps a little bit of Trumpism was coming through.
Well, what was confusing about the post-GFC or Great Recession times was not just the crisis itself, but that new unconventional monetary experiments were happening in America and globally, and the economics behind what we understand of markets has fundamentally changed since that time. I think we met 2010, 2011, 2012, sometime around then. Yeah. People didn't know whether the GFC was going to double dip and happen again. But the GFC, the global financial crisis, wasn't a true traditional style of recession. And why that's important is the normal economic indicators couldn't predict a crisis like that. And what we've seen in financial markets and economics since is a whole new game that 50 years from now, academics will understand what's happening here and now. But here and now, using traditional measures that made sense in the 1980s or World War II or any time thereafter don't really hold true in this environment. It doesn't mean that we ignore what's happening with those traditional measures, but you have to think in new contemporary terms and keep your finger on the pulse of what's actually happening in markets and real underlying economies.
So in your world, in the investment world, what would you say now, maybe the first, maybe the second draft of history?
Yes.
What's the great lesson of the global financial crisis?
Yes. Fixed income markets are a fundamental bedrock of everything that we do in developed markets. In Australia and the US are considered definitely developed markets. What happened around the GFC was a crisis with regards to the very important part of fixed income markets, and we're still seeing that play out 10 years on. We're still in recovery mode from that crisis. That, from an economic standpoint, as we just talked about, has repercussions that we won't really understand for at least another 20 or 30 years. As an active wealth manager, we have to be cognizant of how people have traditionally looked at these type of situations. We still here in Australia haven't had a recession since 1991. We're the only advanced economy in human history to avoid a recession for that long. Why that's the case is a conversation in itself. But what's important to understand is it's still important to look at traditional measures, understand that we are in a different era, that the normal measures don't show us a true indication of what's actually happening, and then try to obviously make sure that we place clients' wealth and clients' positions in a responsible way, but not miss out on potential upside, but also be cognizant that risk means something different in this era.
In my day job, which is being CEO of a business organisation, the Australian Industry Group, which covers a lot of the economy, across the economy, the feeling right now as we're in 2019 is that we haven't gone into recession, but we're in a period of slow growth, and it's sustained slow growth. And we seem to be on that trajectory, have been for some time and will be for some time going forward. And that's making dynamics within the economy change as well. Part of the economy, no doubt, is in recession. I think we have to accept that. But how, from your perspective, do we manage this slow growth period?
Sure. And this is the real conundrum that we face, because the formal way of recognising what is a recession or measures that we traditionally identify as sluggish or recessionary aren't really telling us what's actually happening on the ground. And this is the disconnect between economics and financial markets. Economics is a true science. Finance is the tradecraft that overlays the true science of economics. Why that's important is back in the 1960s, back in the 1970s, the value that an advisor would add to any potential investor or client was that you'd see what's happening in the real underlying economy. Traditionally, when, for example, a real economy goes into recession, recovery generally is, say, for example, 3 to 5 years that follows. You position a client's portfolio ahead of time, knowing that certain assets or certain investments will do well on a potential recovery, and that's the value that an advisor, whether they were a stockbroker, a banker, or whatever advisor at that time, was adding at the time. The issue in 2019 and going forward, and this will be more of an issue with the future, is that the underlying economy and financial markets are detached since the global recession. And what that means is, as we've just talked about a few moments ago, the traditional measures may not be telling you what they used to tell you. That it's still important to have a gauge on what's happening, but at the end of the day, fundamentals are disconnected. And then the overlaying or the conflicting issue that all investors and all humans have is that AI and technology is coming here, and there's a fundamental shift that we haven't seen in any time in human history. And in financial markets and economics, it is naive to think that things aren't going to change very rapidly and very soon.
So just going back to the 8 or so years since we've met, how have things changed in the advice business?
Yes.
I mean, we've talked a lot about how private banking's changed. We've seen the growth of hedge funds. We've seen private equity go through lots of changes.
Yes.
And economic fundamentals have changed, and the old rule books have been thrown out. So how has advice changed?
Yes. There are two main things that have changed in the last 10 years. Firstly, we've seen a rise in technology, which we'll talk about in a few moments' time. But secondly, if you can identify what's referred to as alpha or outperformance, you pay an advisor or an investment manager to deliver you that investment return. It's very hard to find alpha, and in more cases than not, most people should be exposed to what's called beta, or the performance of a market or the performance of a particular investment community at a time. In 2019, there's no doubt that a new category referred to as ETFs, or exchange traded funds, are most definitely a very efficient way of receiving that beta. The difference between now and 10 years ago is there is a wider range of ETFs, and it is much more easily accessible by every Australian, whether they're a retail investor, an institution, a family office, or even our own sovereign wealth fund. The other aspect, as we just touched on a second ago, is technology is fundamentally changing. We've seen across markets globally, both subtly and quite explicitly, that technology is already driving some of the major markets and asset classes around the world. And in the next 6 months, 2 years, 5 years, we'll see this rapidly change. And what that means for advice is a lot of everything that we do in financial services will change to an automated approach. And people need to obviously find a way of adding value and complementing that.
So is it a matter of who's got the best technology?
There's definitely an aspect of that, but again, even with the rise of AI and the change in technology, the human advice model still will add value to superior to what's called a robo-advisor for the foreseeable, I mean, who knows, but 5, 10, 15 years. In 20 years' time, everything will be controlled by AI or computers, but for here and now, a human can still add more value from the actual advice and making sure that each individual investor is well suited. But from an actual infrastructure point of view, technology is here to stay.
Because in a whole range of, let's call them white-collar industries, finance, law, accounting, insurance, it's becoming much more driven by, to put it bluntly, algorithms and the like. Is that still, is that the case in investment, do you think?
100%. So we wrote about this in our newspaper column. In 2017, the S&P 500, which is the benchmark of the US stock market and indicator for the real economy in the US, didn't move down by more than 2% on any given day over that whole calendar year. That's never happened in human history. And if you remember 2017, there was a lot of volatility with Trump in his first or second year, however you'd like to look at that. And yet the main benchmark in the US never moved down by more than 2%. What I'm inferring by that is that basically the computers, whether they're in Frankfurt or in London or New York, are already controlling that market and stabilizing what is traditionally called volatility. Whether that is a good or bad thing is a separate conversation, but the reality is that the technology is already driving the backbone of global markets.
So to an investor or to someone who's thinking about investing or the man on the street, there's this almost disconnect occurring between what's happening in the equities markets and what's happening in the real economy in
100%.
some ways.
100%.
So how do you explain that difference? And is that just going to get wider, or is it at some point there's going to be a correlation between
No, it's a great question, and it's a complicated question, but the simplest way of answering that is, as we alluded to several times now in this conversation, the connection between the real underlying economy, which is bedrocked in economics, and financial markets is now detached. And again, 50 years from now, we'll understand the consequences of what's been happening in the unconventional monetary experience that we've talked about as well, and this new technology coming in. But here and now in 2019, nobody fully understands the relationship anymore between an underlying economy and those indicators that we've talked about as well, and what happens in financial markets. But what is important is you still need to keep your finger on the pulse of what's actually happening. You still need to look at those traditional measures, because even if you don't believe, or you don't believe they fully reflect what's actually happening, other people in markets are, and you should never stand in the way of what the market does. But then you do need to be also cognizant of what's coming around the corner. And the simplest way of looking at that is, rather than looking at just how other investors or how economics works, understand how the algorithms are being put together and what's being put into those algorithms. So one type of market intelligence that's happening across the world is people are trying to understand the actual quantitative employees around these algorithmic models and how they were trained and what they know, because obviously their personal biases and experiences will be reflected in that code or their algorithm. And like anything, you follow the ball or follow the man, so to speak, from soccer, and the same thing's happening with technology.
So when you look at it in the past, history would tell us you looked at history to work out what was happening. Does history still have its place? And if it doesn't, why not?
Yes. Again, complicated and a great question that is. Warren Buffett said that if history was just deemed to repeat itself, librarians would be the richest people in the world.
That's a good quote.
So, and it's funny because it's true.
Yeah.
That said, of course, there's a lot to learn, and to understand what's happening now, you need to have some context of the history. On a side note, I've been a university lecturer on and off for several years, and in that capacity, I've really spent a lot of time explaining to undergraduate students the importance of fixed income markets and how it bedrocks what's called the capital stack, as we talked about several times already today. Why that's important is what happened around the GFC, the Great Recession, when we use these unconventional monetary policies. That bedrock was flipped on its head. So what was traditionally seen as a good indicator would be a bad indicator, and vice versa. And then after what was referred to as money printing stopped, it went back to the other way. Why I've just explained all of that is, if you don't understand fundamentally how it was supposed to work, how can you possibly understand how it's reversed and vice versa? Yeah. So to answer your question, yes, a good grounding in history is fundamental. And like all these considerations, the science is the most important thing, and economics is a science bedrocked in 200 years of tradition. Things are changing.
It's not the dismal science.
Sorry?
It's not the dismal science.
No. Yeah. But again, things are changing, and that's what we've just been talking about. But you still need to understand how we got to this point, and some fundamentals are human-derived, and that's what's referred to as behavioural finance. And clearly there's going to be a happy medium between where the technology is going and this human experience. But things are changing from what we've seen in recent times.
So from your perspective, looking at the investment climate now, what drives investment decisions?
Yes. Again, being cognizant that things are changing, that traditional measures don't necessarily tell you what they should or what people rely on them for, but that you still need to participate in investment opportunities. There is still capacity to be actively involved in markets, but be aware that things obviously change very rapidly and will continue to change very rapidly. What that means in practice is keeping steady hands, still being obviously involved in markets, being aware that traditional measures don't tell you what they should or have traditionally meant. But the conundrum any of us face, whether you're on the advice side, the active management side, or a mum and dad investor making individual decisions, is you can't just sit on the sideline saying the recession's coming around the corner, we should pull out now, without some plan on what you're actively going to do, or vice versa. You can't just be naively actively involved. So it's finding a way that you're actively participating in markets or investment decisions at the right time, but obviously have a plan that when things turn south or things change, you're ready to move in that way.
So does that mean that investment horizons have been shortened?
Well, actually the inverse at the moment. We've seen the longest US cycle in human history as well. And then when you take a step back and look at Australia specifically, as well as we've talked about in this chat, Australia is still experiencing the longest economic expansion of its own in human history. So when you take those two things together, traditionally we should see a change in the business cycle. But even the fundamental economics behind what was considered a business cycle don't really hold up anymore in 2019. That's not to say that you should dismiss those things. Times are very confusing, but like all things that become complicated, it's important to go back to the basics. And the basic is finding value, finding what's referred to investing as momentum, being aware of both, but making sure that you have your own assessment of what really is value and how much you'd like to be exposed to and what your plan is if things keep going well, and of course if things turn sour as well.
So you're an economic historian, and we have had 27 years of growth in Australia. Of course, a recession would have enormous implications for the economy as a whole, so let's not even downplay that.
Yes.
But from an investment perspective, would it matter if Australia's cycle of growth came to an end?
Would it matter from a financial markets point of view? Well, yes, and I hate to echo or shadow what Keating referred to as the recession we had to have, and that was obviously a political furor at the time. But what he meant by that quote was that there are some healthy things that come when you have a recession or a pullback. And the issue that we have here in Australia, obviously, there's a lot of advantage of not having an economic retracement or a recession in 27, 28 years. But the price we pay for that is real inflation, is not what official CPI or official inflation measures tell us. And any of us can work this out for ourselves. You don't have to be a finance person or an investor to know this. We get told that official inflation is 1.5% to 3% range on any given year in recent times. But you go out and you buy your local coffee from your corner shop and you notice it goes up by 20 cents every 6 months if it's a $3 or $4 coffee. Your real life experience is not reflected in what happened in official metrics. Why that's the case is, again, things are changing, and that's not a conspiracy or necessarily a bad thing, but you need to have an understanding of what's really happening and the price we pay for not having a real recession. I'm not saying that we should have a recession, but there are consequences as well.
So I say, in my day job, what we're going through at the moment isn't a wages problem, which is a big issue. It's a cost of living issue.
100%.
And that's essentially what we're facing, sort of the goods and services that we rely on every day, power, food, coffee, we live off coffee. All of that is sort of going up incrementally, steadily, but in a noticeable way.
Yes.
So all of that is sort of impacting on our sense of economic health.
Yes.
Yeah.
And again, there's no conspiracy, but how those numbers were derived is important. And talking about economic history, for example, inflation was actually developed by the British and used by the Americans in post-World War I to work out the average cost of living for an average housewife at the time. And it was specific for a housewife. GDP, which is what we now traditionally use as growth, and it almost becomes a religious term when you talk about economics or finance, was developed again by the British and used by the Americans to work out how much they could suck out of the real economy, put towards the war effort at the time, i.e. building tanks, etc. Now, of course, that the mathematics has been updated since then, but America won the war, or the Second World War, and at Bretton Woods they basically instilled GDP, and the fundamental mass at the core of that measure is just still referring to pulling out economic activity in the 1940s US economy and building tanks and fighter planes for a war. And
so is that still relevant in today's economy?
Yes.
That structure?
Well, no, it needs to be updated. That's the point. So there's no conspiracy, but these numbers have been smoothed and massaged, but at the end of the day, the fundamental algorithm or calculations behind it are out of date. So what's important to know is it's still important to watch all these metrics, but you need to find out what's really happening and find your own way of doing that.
So in this conversation, I just want to come back to the US in a minute, but we've got through this conversation without mentioning the massive change since we first came across each other, which is the rise of China.
Yes.
Which has fundamentally changed global economy, global economic outlook as well. Chinese incomes are exponentially higher than they were 10 years ago. The economy has boomed in different ways, but it's also going through enormous pressures. How has that rise of China impacted investment more generally?
Here, if I could answer it in an immediate way, whoever controls AI and this technology that we've been alluding to during this chat controls the 21st century. There's no doubt about that. out of the top 10 AI and technology companies in the world, China has 3 of the top 5 of those at the moment. So here and now, China is probably leading the world in what is going to be the cutting edge technology and where the future is currently now and where the rest of our life experience will be. That has a massive implication for real life, for obviously our relationship in the Asia Pacific, economically, doing business here in Australia with Asia and the world, and obviously also financial markets. And people are naive to think that the technology and whoever has a better influence on that don't have the impact on all the things that we're talking about today. So from an immediate point of view, China's done miraculously well to not only pull themselves out of a 200-year slump, but basically leading the world in the thing that matters the most when you talk about technology and who has the hegemonic power basically in the world. And this is where the US has led the way in at least my life experience. But you could argue that they've taken their eyes off the ball and maybe spending a bit of time more focused on internal conversations, and the whole world would like to see America get back to focusing on what they have been focusing on, which is the liberties and the institutions that we've all taken for granted, and the technology which should reinforce that.
So can the US, and Europe just comes to mind as not
Yes.
having a big technology presence or company either. They don't really have any technology presence of the scale of the US and China. But can the US continue to compete with China on technology?
Absolutely.
Yeah.
Absolutely. But you don't have to take our own views on this. You hear from world leaders like Elon Musk, and they are fundamentally concerned about what's going to happen not in 20 years' time. We're talking in the next 5 or 10 years. In most recent times, Elon Musk has just launched their newest Neuralink, I think it's called, company, which is basically revolutionizing the link between AI and obviously human bioscience or biomedical science. And why that's important is, at least in that context, we see publicly what's happening in that technology. We want that transparency that America has been traditionally famous for having. Whether you're a fan of what China's doing or not is beside the point, but they keep things very private. And as we've seen in the cases that have gone public, manipulating the human genome without the proper due process, or some of this technology has consequences that I don't think any of us would like to support. So it's not saying that China is better or America is better and who's doing what, but what has come out since the post-World War II hegemonic sort of experience has been that there are institutions that we've all taken for granted, human rights, transparency, and some due process. And when it comes to technology, we want that continued for all the right reasons. And if things are changing and there's a new part of the global economy that keep things private and for better and worse, that has massive implications for everything around us.
Yeah, and that's sort of, exactly where I was trying to circle back to was, in the past decade or so, we've seen the rise of China, rise of technology, artificial intelligence in particular. In the Australian context, 10 years ago, the big 4 banks were dominant, and they've been through their travails and troubles. So that landscape is changing. The institutions we operate by are under stress.
Yes.
And what you see at the moment, I think, is sort of a big swing back to sort of re-regulation, heavy regulation and the like that's occurring. But as a result of that, but those institutions, as we look forward, so we pitch forward another 10 years, will they still be in the same shape as they are now, or are we on a wave or a cusp of significant institutional change?
No, it's a very important question. Napoleon said that all empires die of indigestion, and you could argue that's what we're seeing at the moment, that the Western hegemonic system has had it too good for too long. Just touching back on what we talked about with China, China has every right to pursue these technologies. What right does any other country or society have to tell another country that they shouldn't be pursuing new technologies? So to answer your question with regards to where we're going in the West, rather than over-controlling or over-regulating, which is important in the context of what happened in the crisis of 2007 to 2009, we should now pivot back to what is most important. And again, talking about the history of economics and what we've learned over 200 years is the only thing that moves any economy, any real underlying economy forward is what's referred to as productivity growth, of adding new value. And I think
I'm big on this.
well, exactly, and I think, and this is also how we've connected as both friends, and and worked together in recent times. Because when you understand how important that is, yes, there are times when obviously compliance and the regulation is important for all the obvious reasons. But at the end of the day, if you move the focus when you're talking about Australian banks, whether you're talking about the Australian economy because it hasn't had any recessionary pressures in 3 decades, China, the US, or any of these topics, if we're not being more efficient and what's referring to it adding value to that productivity growth, we're just going sideways or backwards. And that has consequences outside of just finance or investing. That has consequences for philanthropy, charity, development, and also some of those social sciences as well. So this is not just a financial conversation. This, at the end of the day, economics does impact and influence everything else around it. The productivity growth that initially came from what was referred to as globalization brought more people out of poverty than anything in human history. So the link between economics and some of the other social sciences is fundamentally important. But we can see the reverse in the relationship between global warming and globalization as well. So not to say that all these things are positive, but if you're not adding value and getting better efficiencies and what's referred to as productivity growth, you're not moving forward. And technology clearly can move in enhancing productivity growth. But again, that's why it's important to have respect that technology is coming, and it should be coming. It's enhancing it in a way that complements, obviously, a healthy investment horizon, a healthy planet, and obviously what's important for us as working human beings.
Yeah. So from an Australian Standfirst point of view, when you're looking ahead, you're thinking about the investment climate, the philanthropy climate. What do you see over the next decade or so that impacts on the way that you think about investment, philanthropy and the like?
So our priority here at Australian Standfirst is to be the thought leader for investor and philanthropic education. That sounds nice, but why we say it in that way is what's important is to understand all the things we've touched on today. And until you actually understand or have a comfortable view of what's happening in the world around you and what's likely to happen moving forward, how could you possibly make any decision about the future, whether it's financial or otherwise? For a whole lot of odd reasons, Australia has had a real vacuum in this investment and community education space, which is a whole conversation in itself. So our approach to adding value to everyday Australians, and obviously the investment community and the philanthropic community as well, is trying to put some context of why we're here, how people can better understand the winds of change that are coming, and then through that better understanding, make a decision whether certain investments are right for them moving forward. And that's also a consequence of the fact that in Australia, for whatever reason, and there are a number of the reasons, the relationship with investing has been the inverse, that people worry about the actual investment first and some token explanation or context after the fact. And it's not surprising that we now find ourselves in 2019 with people who don't really understand what the economy is actually doing, why their investments behave in the way that they do, and have any possible view of what's going to happen in the future.
We live in interesting times,
Absolutely.
as they say. Stirling, great to talk to you. Thank you.
Thank you.